Good afternoon and welcome to the Börsentalk 2021, the third four webinars organized and brought to you by SIX Swiss Exchange. My name is Andre Buck, Global Head of Sales and Relationship Management, and it's my great pleasure to introduce this ETF panel and welcome you wherever you are here with us at the Swiss Stock Exchange. Before we start the ETF panel, let me introduce you to some features of the webinar of the Hop-in tool. This webinar will be recorded and can be watched at a later stage at your own convenience. An email will be sent out after the event with the links to that. I also invite you to actively participate. You can submit questions at any time. And we also have prepared some polls. And obviously, I would be pleased if you could take part once these polls are shown. Just use the buttons on the right-hand side and just switch between the polls in the Q&A. Now, ETFs have been very popular in demand for a long time. We were ourselves an early adapter and started offering these products the first time in 2000, over 20 years ago. And ever since, ETFs have grown to a substantial size and importance. Today, we're close to 1,600 ETFs, a yearly turnover of over 100 billion Swiss francs, and more than 1 million trades, 27 issues and 16 market makers. We are one of the largest ETF exchanges in Europe. Constant investments and listening to our customers are key to achieve this level. And to prove the point, currently we are rolling out QOD, quote on demand, which will certainly bring us to the next level in ETF trading. I'm sure some of you have already heard of it. But enough of SIX praising. Let's bring on the panel. And without further ado, I happily hand over to Debbie Furr, our moderator for this afternoon's panel. Thank you, Debbie. Take it.
Thank you. So I'm excited to be moderating this panel. We have some experts here, and we're going to ask each of them to introduce themselves. So I will go in alphabetical order. So why don't we start with Jörg?
Hi, everyone. My name is Jörg Seifelder. I work for Flow Traders here in Amsterdam. We're one of the largest market makers for ETFs in Europe. And I'm covering the German-speaking institutional client side for us.
That's great, thanks. And Jürgen?
Good afternoon, my name is Jürgen Blumberg. I'm responsible for capital markets product on the ETF side for GSAM, Goldman Sachs Asset Management in EMEA. And I'm very happy to be part of this panel today.
Thanks, Jürgen. And Sasha?
Good afternoon from my side. My name is Sascha Widin. I'm working for Credit Suisse Asset Management here in Zurich. We are managing the global multi-asset portfolios. So within these portfolios, we have direct, active, and especially also passive investments. And we were actually pioneering on the Swiss market in 2009 by launching pure index or ETF-based mandates and fund of funds.
Thank you. And Slav?
Hi, Slavomir Rzeszopka. I'm based in London with James Street, where I'm responsible for the ETF sales and trading business.
And Slav, I'll stay with you. Let's start with, what were the lessons learned in 2020 for ETFs?
I think it's actually somewhat ironic to say in the context of how difficult 2020 was for the world in other respects. But for ETFs, I think the product really has proven itself during the course of this year in a few different ways, right? Like the infrastructure that has been created, including like the efforts from Swiss Exchange for over 20 years and from other exchanges and from other providers, proved resilient enough so that investors were able to get access to products, to liquidity, and in fact express their views during the heightened volatility caused by COVID pandemic, putting on trades in ETFs. And from that perspective, I think one of the key applications of the product was tested and successfully passed the exam. Also, I think what is very notable is how the spectrum of users of ETFs broadened even further during 2020. So on the one hand side, I think we have the phenomenon of more retail trading, happening basically everywhere globally. And very often those retail investors chose ETFs as a means to express their investment opinions, which again led to more inflows into those funds, but also more trading volumes across pretty much all exchanges globally. And on the other side of the spectrum, you have like some of the largest institutions globally, and it would be amiss not to mention facts that the Fed to use ETFs in the quantitative easing policies, and that's sort of the ultimate validation that the product is applicable and useful to investors from all the way from retail to institutional. And I think at the end of the day, what it actually highlights is how democratic ETFs are, given the what I just said, like how the same ETF and actually the same exact share class, where you don't have a differentiation between how you are able to access it or what fees you're paying, is in fact useful for both a retail person saving in their account and to institutional investors around the world.
Yeah, that's definitely been one of the big appeals of ETFs over the years. Jörg, when you think about liquidity, how do you talk to investors and how do you help them understand liquidity?
First point is that you always need to look at the ETF liquidity as a kind of, I always would say, an iceberg. So you have a visible part and an invisible part. And the visible part is what you can actually see on exchange, what you can see in the order book on the different exchanges. But that's just a very small fraction of the liquidity that we have in the ETF market. If you go deeper into the invisible part of the iceberg, that's actually where the real liquidity of an ETF lies. That's for one, the underlying liquidity, so it depends on the relevant index that you have. You have the cash market for that index and for the constituents of that index, and you have the possible derivative. Easy example, always you can say, let's say, for example, an SMI ETF that is not traded on exchange at all, where you see no volumes going on, and you have on the other side another SMI ETF that is traded very heavily. Normally, investors would say there's a difference. The one ETF is more liquid than the other. But when it comes to on the trading side, for us as a market maker in hedging, there is not a big difference because the underlying liquidity of the SMI cash stocks and the SMI futures is there. So you can always very, very easily trade those products. It really depends on the underlying. And when we look at the volumes traded, especially when we only look at the volumes traded on exchange, then we're missing out like 80% of the real flow. Because ETFs are traded mostly OTC via MTFs and other instruments, and this is where the actual trading volume is generated in ETFs.
And often people differentiate between what they would call primary and secondary trading in ETFs. Maybe you could explain what are they talking about when they say that?
So basically, primary trading is always when it comes to the trading on exchange or OTC directly with the market maker, like ourselves. And the secondary market liquidity, that's always when we as a market maker directly create and redeem with the issuer. These are the two parts that you can see.
Okay.
And looking at the liquidity for each and every ETF, there is a creation and redemption market, and that's one part of the equation. But the other part of the equation is also we as a market maker, we have always some inventory, so we can try to spread compared to what is actually in the primary market achievable.
Okay, thank you for that. And Sasha, last year, how did you experience liquidity when you wanted to use ETFs?
Yeah, it's true. Last year was an extremely demanding year, especially, of course, during March, April, then the recovery But I mean, in March, we saw really strong dislocations in the markets, especially on the fixed income side. As an example, there was one of the biggest US fixed income ETFs, actually, with around 80 billion of assets trading with around 6% discount to NAV for 1 or 2 days. So, and if you look at the longer term NAV chart of that ETF, you see actually almost a match on the NAV in terms of a listed price. So this shows actually that it was really exceptional. However, what we try to avoid is exactly to trade in these markets. So we stick to our guns and wait until the volatility reduces again. And in contrary, in some cases, that there were actually nice opportunities to pick up some ETFs in a discount situation by expecting that this will then normalize again and coming back in terms of price back to NAV. But I think in general, the liquidity was exceptionally good. So I think we would have been able to trade in these markets. We didn't, but I think especially the spreads of the ETFs were actually much more narrow than the underlying, for example, bonds on the fixed income side. And this was definitely a proof of concept, also a bit against all the criticism we see on ETFs. So in my point of view, ETFs behaved very well last year.
That's great. Slav, maybe coming back to you, can you help us understand what caused that discount and premium that we saw with fixed income ETFs last year? You're on mute if you're talking.
So I will be the person doing that mistake this time. So there's been a lot of debate about the premium discount point in fixed income ETFs. Prior to COVID, and I think what happened last year during the COVID volatility crisis sort of provided a lot of empirical data and evidence to both sides of the debate. I suppose from the perspective of how we would see things developing, it probably is worth starting by saying that we view ETFs as being a leading vehicle for price discovery in fixed income. So effectively, it's very clear what Sasha mentioned, that when you looked at discounts to published NAVs in some of the even very large fixed income ETFs, there were days when they looked pretty scary, but the methodology of calculating those NAVs was often just like not catching up with the market moving extremely fast, meaning that the way how cash market works for bonds, there was simply no trading happening in a lot of those bonds that go into the baskets of fixed income ETFs. And therefore, pricing was a little bit stale from that perspective, whereas ETFs acted as a transmission belt for exchanging risk between market participants. And you could actually make a point, and we are certainly making this point, that from that perspective, the real price of risk transfer in the market at that point in time, assets such as high yield or emerging market bonds, was actually where the ETF was trading, or close to where the ETF was trading. And also, it's important to note that it was quite difficult to transact in many of the underlying bonds, because at that time maybe there were not that many people keen to buy debt issued by cruise companies or airlines or some of the other industries where risk was most elevated. But there was a functioning market in fixed income ETFs where should Sasha choose to buy or sell, he was able to do that. Obviously, it required investors to get comfortable with the perceived premiums and discounts in the market. So I think from that perspective, it is unsurprising to see what happened with ETFs. I think one very positive thing, and this is credit to all the work that issuers like Jürgen, for example, have put into building infrastructure, is that we basically did not see any disruptions from the perspective of creations, redemptions. And that is absolutely critical, because that means that authorized participants and market makers are actually able to perform the role and are actually able to provide liquidity and provide markets in the secondary market trading.
That's great. So in essence, ETFs were a better pricing vehicle than the underlying bonds.
Yeah.
Okay. So Jürgen, turning to you, and you can add some thoughts on that question if you'd like to. But I think the other would be, from a retail investor's point of view, how should they think about liquidity and trading in ETFs?
Yeah, so Slavomir mentioned before that retail investors are becoming more and more important in Europe as well. We see that in the States, where the biggest part of the global ETF market is domiciled. We see this there for quite a while. However, it's often channeled versus advisors, but more and more retail investors, really, they know the tickers of products and really know these favorite tickers in and out. In Europe, for a long time, this has not happened. And we see now that demand really picks up. And so far, the European market is really dominated by professional investors like Sasha, for example, but more and more really end retail is entering the market as well. But they're not entering the market all in the same way. So when we talk about end retail, it's very important to talk about the great diversity in the segment. So we see retail investors who use neo-brokers, for example, to trade by trade. We see others who have their savings plans and invest a fixed amount on a monthly basis. We see other retail investors who trade via platforms, and there could be others who consume whole portfolios. And this leads to the fact that they have totally different demand when it comes to trading and liquidity. For example, somebody who consumes a whole portfolio or who consumes a savings plan, they will typically not be very interested in the spread of an ETF. They will be more focused, for example, on the execution fees, which will be charged. The ones who use neo-brokers, they will be more interested in access. So can they access the funds they have researched on the internet, or are they maybe limited to a short fraction or a small fraction of the market? And then obviously there are the self-decision makers who choose trade by trade, what they want to buy or sell. And for them, it's more important what the bid-ask spread on exchange is. However, for all of these retail investors, the market depth will typically less important than for professional investors. But on the flip side, all these additional fees, which will be charged by brokers, or for example, if you have a savings plan, if that is sponsored by the issuer and you do not have to pay any fees if you go in and out when you invest your 200 Swiss francs per month, that becomes more important. So from a liquidity education point of view, I think the needs are completely different. And that's why it's very important to really focus on this specifically as well.
That's great. So I think there's a poll that they would like us to do right now. So I'm thinking that we should do the poll. I'm hoping everyone sees the poll that they posted. It says large asset managers are increasingly among the largest shareholders of highly capitalized companies. How to deal with this is the question. Don't know that it actually is showing to everyone. Does anyone see the poll? You do see it? Okay.
I assume we are not allowed to vote?
If you want to vote, I don't see why not. I don't think you have inside information here, so you can express your opinion. Okay, I think we can move on to the next question. So when Jörg was speaking earlier, he mentioned RFQ platforms, and I'm not sure that everyone knows what that is. So maybe Slav, can you talk about how institutions are trading ETFs and explain what is an RFQ platform?
Sure, thank you. So request for quote protocol, which is what RFQ stands for, I think is fairly well known in markets also different than ETFs. But as it happened, the way market structure developed for ETF trading in Europe in particular, but we also see this being adopted outside of Europe in Asia Pacific or to some extent in the US, is that most institutional clients decide to express the investment interest trading in this way. So in essence, it is what the name stands for. So an institutional investor is able to send a request for quote to a number of dealers that they want to include in this auction. And they are polling those dealers for prices. Prices come back, and the investor is able to trade on the best available quote. Now, to facilitate that process, a lot of innovation happened in terms of creating electronic platforms so that this process can be fairly efficient. As you can imagine, with large portfolios, a lot of investors need to trade hundreds and hundreds of tickets in different ETFs, so it's more efficient for them to use electronic tools. These typically operate as regulated platforms in Europe, so they are multilateral trading facilities. And now we are also observing different exchanges adding this way of trading to the repertoire of what they offer as avenues for execution to end investors. Since MiFID II, trades that are being done on those platforms are also visible from the post-trade perspective. So to some extent, I would say this method of trading, even though it's different than central limit order book trading, which is typically what you'd expect from exchange-traded fund, is also a little bit far away from manual trading and becomes really highly automated. Again, if we go back to COVID volatility in 2020, I think on the busiest day that we had in March on our desk, we responded to a request for quote in an ETF every 2.5 seconds. And that's quite a lot of requests for quotes to handle manually. So you can deduct that obviously this is a fairly industrial process, both on the side of price providers as well as users who are able to plug into the technology offered by exchanges or platforms to facilitate this workflow.
Okay, that's helpful. I guess one question that many investors wonder is what happened to the thought that we were going to have this consolidated tape? Because many people thought we wanted to have more transparency under MiFID II about trades that were happening. Can you talk about where that went to?
Yeah, the consolidated tape is something that I think everybody wants. Everybody wants, and as Slav said before, since the implementation of MiFID II, a lot of these OTC trades or trades via these RFQ platforms, MTFs, they are reported now. So they are reported. You can get them. You can see them. The only problem is right now there's nobody really there that wants to consolidate that and put it in one place, and also really pay for that. I mean, you can do the work. You can sit down. You can really pull all the data from all different sources and build yourself a consolidated tape. But there is nothing yet in Europe that can really show it for everything. Especially also now since the UK has left the European Union, it's getting even more difficult to really bring everybody to the table and make sure that we really see a combined or really an aggregated tape for all the flows and all the volume that is going on for individual ETFs.
Yeah, I think there's an expectation that maybe the European Commission will tell someone they need to make it. So I think it'll be interesting. I think Tilman Luder's been thinking about ways to implement that going forward. When you think about last year and now the first 5 months of this year, which have been phenomenal, we've had record inflows. The European ETF industry is at $1.5 trillion, 96 billion of net inflows through just May. which is very close to what we had all of last year. What types of ETFs do you see investors investing in this year?
I mean, the majority, to say first, the big trend that is still unbroken from last year is ESG. That is when you really look at the flows, then you really see that ESG is dominating, and it's not only dominating in the equity world, but it's also dominating already this year in the fixed income world. That's the ground tenor that you have throughout the year so far. When you look at the developed market equities, then it's mostly inflows into the US, and into the big funds there. When we're looking at emerging markets, then you still see some inflows into China, which is still unbroken. It's not at that high level that we had last year, but it's still on a quite stable level. Secondary, when you look at the bond market, the fixed income market, you can see as well there, as I said, the ESG funds are dominating, and you see inflows in the US investment grade part, and also still in the emerging markets. And when we talk about emerging markets, then we especially see China government bonds as a main driver of the flow this year. What is going down a little bit, and where you see some outflows, is in the real safe havens like the developed government area, like German bonds and all that. That is rather where you see outflows in the market. When we when you look at on the thematic side, then it's pretty easy to see that it's very much news driven traded. So that means in recent weeks, months, you always heard the inflation topic coming back up, and immediately when you hear that, you see the inflation-linked bonds coming back into play. You see again gold is rising again. You see again on the thematic side that the gold miner are coming into play. And that's really something that you see really the cyclicals are coming in. Also, when you see on the sector basis, you see the banks being bought quite a lot. And on the real thematic ETFs, you still see that healthcare, clean energy, those parts are also still bought by the clients. And obviously, last but not least, that you have to mention in that way, or for 2020, was the crypto ETPs that were quite dominantly traded and listed on the Swiss exchange. And there you saw, with the rise of the cryptocurrency, massive inflows and massive trading going on, also then in the time of the downturn.
Thank you. And Sasha, how are you positioning your portfolios this year?
Well, actually, we have 3 topics in that sense. So the first topic is we constantly monitor our existing holdings. We screen for new ideas, for new providers, new techniques maybe also, or new topics in general, now new sub-asset classes which are available as an ETF, for example. ESG is definitely a big topic, so we shift a lot of assets into ESG framework, which we just actually defined. And there you see the same development actually as we saw with the traditional ETFs or the traditional indices. So the equity ETF area is leading in ESG, so there are quite a lot of products already available. On the other hand, fixed income is evolving. There we still have some gaps. We are eagerly waiting for some sub-exposures within ESG, especially in the non-core bond segment, like high yield, emerging market exposures. And the third topic is actually when we look into the cycle of the markets. I mean, we are at all-time highs in equities, bonds in the meantime, not anymore at all-time highs, but I think fixed income in general will be a bit less in focus than the equity side in terms of potential performance expectations. And within fixed income, definitely we diversify into the sub-asset classes, as mentioned, high yield and emerging market bonds. But we also use, for example, AT1 exposure, so cocoa bonds, AT1 exposures, or preferred shares, which is a nice add-on in the portfolio. So we try to find different income sources, especially diversifying a bit away from government bonds, which are really very low in yield level.
And have you seen much demand for crypto from private clients, or are you using it within your portfolios?
So we are not directly using cryptocurrencies. Indirectly, we could use, and maybe that's also another topic, thematic ETF, which indirectly, for example, play the blockchain story. But crypto direct, not yet possible now. It's also an interesting topic in terms of volatility, which it may add or take out of the portfolio. It's a nice diversifier because it's highly uncorrelated in some cases, but within a multi-asset portfolio, not yet.
And last year, there was a lot of flows going into physical gold. What's your view on gold this year? Because there is some concern about inflation, where we often see people investing in gold.
Mm-hmm. So we were positive for gold, or we had at least a small gold position for a certain period of time. Not for the moment. We are more in the broad commodity complex invested. So this means in the broad index, where we indirectly hold as well gold. But commodity in general, we have more neutral view now. But in terms of reflation trade exposure, it's still a component of the portfolio, not overweighted anymore.
Thank you. And Jürgen, since Goldman Sachs has both ETFs in the US and in Europe, can you talk a little bit about active ETFs? And also, is there a difference when you think about liquidity with active ETFs?
Yes, no, that's a very good question. And I think at the moment we see that the ETF industry diversifies a lot. So it has started with pure passive benchmarks, and now for a couple of years we see smart beta products, and in the US, as you rightly mentioned, we see the first active products as well, which have then a kind of proxy basket, which is published to the market to really price them accordingly. In Europe, at the moment, we do not have this kind of facility yet. So active ETFs, which are not transparent or semi-transparent, are not approved in Europe so far. You can have an active product, but then you need to disclose your product on a daily basis. And that's obviously something which some active managers shy away from. So it's a very important topic. And the question is, of course, do investors need more products? And our view is that diversity is good. And you just heard what Sasha said as well, that he is always keen to look into new products. And if there are some features which are more interesting for his portfolio, then I'm sure he's keen to consider those as well. So we think from our point of view that smart beta active is good. And it's good that investors diversify away from these pure passive benchmarks. But still, if I look at the global pool of assets in ETFs, I think more than 15% are still in S&P 500 products. And you could ask, is that the most efficient way to invest your money in an index which was developed decades ago and which is purely based on market cap? And I think today you can include science, you can include really research into those products and develop something which for some investors is quite exciting. But coming to the second part of your question, what does it mean for liquidity? And the title of our webinar is obviously, does size matter? I think it's not all about size when it comes to products. I think there are many more factors which play an important role. And I think one of the biggest one is obviously trading volume. I know many very small products, for example, leveraged or short products, which have a very attractive market because they have a lot of trading volume and attract more market makers, attract more authorized participants, which creates more competition in the market as well, which is another important point. If you have a platform which is very open, which allows a lot of traders, brokers, authorized participants to participate, that's usually good. Then you need to look into this primary market mechanics of the creation redemption process. Is this very transparent for authorized participants? Are the costs disclosed? Are there fixed cost components, or is there a slippage element? So this all adds up to the fact if a product at the end can be priced effectively or not. And what many people do not know is that usually in Europe, at least, asset managers or ETF issuers, they choose a market maker partner or multiple market maker partners and pay for that service as well. And again, that's something which is not the norm in the States, but here in Europe, it's the norm. And that's why you can see very tight spreads, even products which are quite new and which are just building up. So I would not say that active ETFs or smart beta ETFs automatically always have to have a higher spread or a kind of worse liquidity. But you need to get all of these layers right. And obviously from an AP point of view, but that's something which Jörg and Slavomir can answer better. It's very important then to have a correlation to, for example, a future or an equity basket or something which trades liquidly, which they can hedge against. But if we talk about something like emerging market products, they will always have to have a kind of proxy hedge, because a perfect hedge will not be tradable at the same point in time because so many markets will be closed. So it was a long answer to a short question, but I think there's no easy answer. And I think it's good that the market gets broader, and we are looking forward that active ETFs will be approved in Europe as well.
Thank you. I think an interesting point that's come up, Jörg, which I'm going to come back to you, is as investors start thinking about ESG, often they're moving from market cap into an ESG portfolio or ETF, right? So maybe talk us through, if I'm thinking of doing that, it probably doesn't make a lot of sense for me to just sell one ETF and buy another. So how should I be thinking about making that, I would call it transition, right?
Yeah, I mean, first of all, just to add one thing to Jürgen's point, where he said that you can to the liquidity of futures, for example. We have seen that in the ESG space, the spreads have been, when they were developed like 2-3 years ago, the spreads were quite wide at these days. But due to increased trading volume and also due to the increased usage nowadays of ESG futures, for example, where you have all of a sudden now a liquid future as well, the spreads have significantly tightened. And then there's the second space when it comes to transition trading. You can always, I would not sell one product, buy the other product. In an optimal world, you would buy one product, sell one product, both at NAV. So basically you take out the market risk from that trade, and you basically only switch out the underlying stocks that are not in the ESG part, and you buy in the stocks that are not in your current core market part. That's a very easy way to transact that. Nevertheless, when it comes to these transactions, you always need to look at the underlying stocks. If there are, for example, taxes involved, those need to be paid. A lot of investors always say like, yeah, but the basket has 80%, 90% overlap. But nevertheless, the shares that need to be bought, especially when there are UK ETFs or other ETFs with a tax component, those taxes need to be paid.
This actually sounds pretty complicated, but I guess maybe this is a good point for Jürgen to explain the role of someone in capital markets, because clearly there's a lot to understand and not everyone's going to know what to do. So
yes.
Can I turn to you, Jürgen?
Yes, no, thank you. Our job is to make it easy for investors, obviously, at the end, but it's still important to understand the mechanics. But for me, but maybe I'm biased, capital markets is the best role within the ETF world, because it touches so many different areas. And when I think about capital markets, I've just read an article, I think it was on Ignite or Financial Times, and the tone of the article was that every ETF issuer, even when they launch, they should start with a capital markets person, because they cover so many different areas. So as capital markets, and most of the issuers have this function, you can interpret this function in various different ways. You can be very focused on product development, for example, and you can be very focused on the primary market process and purely take care of the creation redemption ecosystem. You can be very focused on the administrator side, on the custodian side, and deal really with these kind of service providers. Or you can be very secondary market focused, which would then be the end clients, and really guiding them and helping them to invest into the ETFs. And something what many investors do is that they talk to capital markets teams to really find the most efficient way to execute the product. And if they want to find the best product for an asset class, they would talk to Slawomir or to Jörg and ask them what's really the most efficient product, because they can be independent on that side, where we obviously have a bias towards our products. And in regards to maybe a couple of examples, what capital markets people usually do, one of the most important functions is to look for seed capital for new products. Another one would be to research the market, so be very data focused and see which products flourish, and then try to make suggestions in regards to product development, and really with the client angle as well, talking to clients and really harvesting ideas and bringing them back in-house to the product development and product strategy departments. Then another important role is to take care of the authorized participant ecosystem, to onboard a sufficient amount of authorized participants that they can create, redeem in the primary market, because competition leads to better prices in the secondary market as well. And then you can interpret the function as well, very, very client focused. And that's something which we do as well. So I spend most of my time in client conversations, either talking about the product or talking about the implementation. So really guiding them, does it make more sense for this trade size in this market environment to trade at net asset value? Does it make more sense to time the order and trade at a risk price? What do we see in the primary market? Which authorized participants are active in this product? And then we can give some guidance to investors to really help them. And that's something what very active investors like Sasha doesn't need anymore, because he has a dedicated ETF trading desk. He has done a lot of ETF trades, but we still see a lot of professional investors getting into this market. And they mainly have questions around this liquidity ecosystem, because that truly differentiates the ETFs from active funds. And when an active fund buyer decides to choose an ETF, that will be the area where they will have most of their questions. And that's why it's so important for us to help. Maybe especially in our house, we've started to launch ETFs in the States 6 years ago, in Europe 2 years ago. So it's something what our client base really appreciates. And I'm almost or always astonished to see as well, for example, for a China bond ETF, how even a big trade can be executed at 3 or 3.5 basis points. Even in trading hours when China, so the home market, is closed for many hours already. So you really see this additional value which ETFs really deliver. And one thing which people always need to take into account as well, the ultimate pool of liquidity for any ETF is the underlyings. Because through to the creation redemption process, the underlyings can be tapped into. And maybe coming back to this China bond example, Chinese government bonds trade around 30 billion every day. So if clients come and have worries if they can place a 50 million or 100 million, it really helps to put things into perspective.
That's great. So Sasha, given you are an expert in using ETFs, given your portfolios and the length of time you've been doing this, can you share some tips on ETF due diligence? Like, how do you pick the right ETF? What do you do to figure this out?
Sure, happy to do. But first, I would agree with Jürgen on the capital market role, especially when we have complicated trades to do. So be it, for example, hand out the content of an ETF in the physical form of this underlying stocks, or arrange fixed income switches or things like that. It is very helpful to talk to the provider and to assess how to do the trade best. So that's a very important role, definitely. Now, in terms of ETF due diligence, also here, Jürgen also mentioned, and Jörg as well. For me, the first and most important point is to understand the index. What is in the index? How is the index calculated? What are the index rules of an index one would like to track? A good example here is, for example, dividend ETFs. You have several ETFs which have dividend in the name, but actually the methodology how this dividend exposure is taken into the ETF is completely different. It could be naive, just taking the yield. It could be matched with other metrics within the index. So that's very important. So first of all, what is the index doing? How often is this one rebalanced, as an example? Also here, a very interesting example. For example, MSCI rebalancing happened by end of May. So the US indices on US value and US momentum stocks were rebalanced. And what happened is actually that the sector exposure within those indices changed completely. So for example, financials went up from 1.5 to 40% of an index, which one from the outside doesn't see. So it's important to understand the index. Then, of course, always important, check the prospectus, check the kit, see what is defined there as risk, how is the provider treating the ETF itself. Also important, what is the legal structure of the ETF, the domicile? Is it a Luxembourg-based ETF? Is it an Irish ETF? Is it a Swiss ETF, a Japanese regulated ETF? This is important also in terms of tax consequences. So depending on the underlying, you have a better tax treatment for you as an investor or not. So you have to take that also into account. Size of the ETF, it depends. We just heard from Jürgen, it seems that a 50 million ticket is very high, but when the underlying market is extremely big, it doesn't matter too much. But the ETF itself, especially when the ETF is new, of course, in most of the cases it is a small ETF, but also here it depends what is the ETF tracking, and the underlying is important in terms of liquidity, and this defines then the tradability of the ETF. What we also check is authorized participants, how many market makers, very important, how many are the large market makers involved in the ETF. And maybe not so important anymore, at least not so often anymore discussed, physical versus swap construction of an ETF. It was a big topic a few years ago. Now it's a bit less a topic, but of course one has to understand, is the ETF based on a derivative structure, or is it physically implemented? And if then, is there securities lending involved, yes or no? How much does the ETF benefit from that securities lending, and so on. So there's a sub-segment which is much more in detail, but I think these are the most important points. Maybe listing is for some investors also important. Where is the ETF listed? For us, it's less relevant. We can trade globally, but some retail or smaller investors may only trade, for example, in Switzerland.
Thank you. That's great. So there's one more poll, and on that poll, it talks about the ICSD settlement model. So either Jürgen or Slav, do you want to explain what that is before I launch the poll and people may not know what it is? Whoever wants to go first can raise their hand. Okay, if no one's going to raise their hand, I'll pick someone. Jürgen, you're smiling, so I guess I go to you.
Thank you very much, Debbie. For us, because we just launched 2 years ago, we launched an ICSD, but it was really a big migration process in the market. And in the past, there was domestic settlement, and now there's the international settlement model, which has a dominant role in the European ETF market. It has made many points of ETF trading easier. So you can cross countries better with positions of ETFs. That's especially interesting for market makers and authorized participants who might have bought and sold in different countries to really match those positions. I think it has made life easier. At the beginning, there was a migration phase where I think there were some problems as well, but we have overcome that, and I would describe ICSD model in Europe, I would describe it as a market standard now. Perfect.
So I'm going to launch the poll, and this one is specific to the ETFs. So hopefully everyone sees it. So the question is, what is the most important criteria for you to trade an ETF? Is it size in terms of assets under management? Is it bid-ask spreads? Is it liquidity of underlying securities in the futures market? Is it ICSD settlement setup, or access to preferred AP broker? Okay, so we are running down to the last 10 minutes here in terms of our time for this panel. And so someone has asked a question, when will the first Bitcoin ETF come to Europe? Well, I don't know who wants to answer that because we already have Bitcoin ETPs, not ETFs, but maybe someone can just quickly answer that since that's been voted to the top as question.
Well, then I will go for that one, right? I mean, we have the Bitcoin ETPs already in Europe. We have it from several issuers by now. We do not only have the Bitcoin, we have Ether, we have Polkadot, we have even baskets of different cryptocurrencies. I mean, the number of issuers is more or less growing by the day. So I think there is a lot of different ETPs to choose from, and to really look at all the cryptocurrencies that you really want to have. Mostly, there is no Dogecoin or anything like that, but everything that has a little bit of some assets in there, then there is usually an ETP out there.
Yeah, that's good. So the next question that came up was thematic ETFs. How does their underlying construction affect the underlying securities?
I can maybe talk to that one. I think it's quite interesting to observe the evolution of product development and also patterns of interest. Some of those thematic ETFs have been around for quite a long time, like, I don't know, timber and forestry ETFs or clean water ETFs are things that have been on the shelf in Europe for more than 10 years. But clearly there's a lot more focus in trading those products. And what we're seeing really is a little bit similar, I would say, to what has happened in, say, more exotic exposures that we maybe often didn't associate with ETFs. So we often talked about liquidity of the underlying will actually drive the liquidity of the ETF. But you can imagine that the theme that the ETF is trying to replicate is very, very narrow and very concentrated. Then you're actually starting to have the effect where, in fact, there isn't an infinite amount of liquidity in the underlying asset class. And clearly then it just goes back to the point of there's a price for everything, and the ETF will reflect the price that someone is willing to pay for that exposure. But I suppose for people like Sasha and other investors, that just like adds more relevance to actually pay closer attention to how the product is constructed, what does the index that the product is tracking will be doing. And for firms like us, it sort of means that we have more conversations with investors that want to trade in size in those ETFs, where we try to talk to them about things like expected impact cost of executing larger orders in those ETFs, and discussing with them overall what to expect when they are going to use those products in their portfolios.
And maybe following on, what are best practices around ETF trading, and how does that impact liquidity?
So I think in essence, I would still argue that ETFs are extremely straightforward when it comes to the product construction. But clearly there are some challenges and some things which will determine the positive outcome for any investor when they're using the product. And these are mostly related to just paying attention to what the product does. I suppose the first complexity is really that it's a product that is an open-ended fund but trades like an equity. So we often see investors approaching it like they would trade any other single stock, and that is clearly missing a layer of liquidity, like Jörg was explaining earlier. For other investors, they are just very tied to maybe executing always at NAV. And this is very much trading like they would invest in any other mutual fund. And again, that probably misses the point about ability to exchange risk very quickly and sometimes capitalize on that functionality of an ETF. So really, taking an ETF for what it is, I think is a great first step in making sure that your trading is efficient. Then a lot of things that have been explained so far, as in like doing your homework in terms of understanding what the ETF replicates, what are the factors that will determine the liquidity of the ETF, potentially engaging capital markets of the issuer for some sort of pre-trade analysis, and also just like what I would say commonsensical tips from the perspective of what you would be doing when you're transacting. So avoiding trading at market open or market close, avoiding trading exactly at the time when big macroeconomic numbers are being published. These are things that will likely result in like tighter spreads. What we are also observing right now is, with increased ability to automate and provide liquidity in very efficient fashion, for example, it, from our perspective at least, clearly makes sense to always request for two-way markets rather than for one-sided markets, just to eliminate any potential sort of information leakage when it comes to trading.
Thank you. So we are down to the last 3 minutes. So I'm going to give each of you about 60 seconds, sort of, to shortly less than 60 seconds, to share any last minute thoughts you would like to share with the audience. So go around. So Jörg, you're on the top. So start with you.
Yeah, basically, I just want to say thank you. And to the whole topic of ETF liquidity, everybody should really think about what all the speakers have said now, and that the ETF liquidity is not what you see just on exchange, but there are multiple layers in the liquidity of the ETF. And we hope to see more trading going on, more assets coming into the product. And yeah, thank you for having me.
Great. Sasha?
So first of all, I would like to thank for the great panel and to have the topic ETF. I think ETF will never go away again. It will grow, and there's a lot of room to grow, especially in new ideas like ESG or other market segments. And for us, it is a very important toolbox for the portfolio construction.
Perfect. And Slav?
Again, thank you for the panel, and also thank you, Debbie, for moderating as always. That's a real pleasure. But I would say, I don't want to sound cheesy, but it's really very exciting time for ETF industry. You mentioned some numbers in terms of the growth, and many people maybe thought that the trajectory of the growth of the ETF industry will just like slow down at some point, and we are not seeing this at all. And I think with many interesting innovations on the horizon, it really, I think, pays to spend time looking at what is available within the ETF landscape and think about how we can use those products in our investment portfolio.
Okay, and Jürgen, you get the last word.
Yeah, so I'm very proud to be part of the ETF industry, and I thank everybody who dialed into this panel as well, because for sure you have contributed to the growth of ETFs, and I have no doubt that ETFs will continue to benefit portfolios in the future. And Debbie, I thank you very much for moderating us, and SIX for their partnership in general.
Yeah, you guys were a great panel to moderate, so thank you. And I agree, the future is quite bright. We've seen assets more than doubling in the past year, and flows are on a record, I think, to see over $1 trillion come into ETFs this year. So exciting times. I think it's a great product, and thank you, and hopefully see you in person somewhere.